Hello everybody, my name is Valentina Luguarias and I'm an MBA student at IPME Institute, and today I'll be guiding you through some of the components of my corporate financial management class, which was taught by Proffesor Roy Sembel, which includes financial risk management, internal company management, investment strategies, ethics, and also some business conduct discussions. So let's get started. Corporate financial management is about managing the internal and also the external financial resources to create a significant and also sustainable value. Or as Professor Roy Sembel put it, an optimal orchestration. Now, it involves balancing the risk, optimizing the investments, and ensuring that the ethical business conducts are aligning with the business objectives. Now, I'm going to be putting them into different perspectives of how we see every topic. The first one is the internal management company view. So, moving on to the internal management of the company, the goal here is to create the value. That is the optimal goal. According to Ramcharam's 5 business essentials, companies are focusing on 5 things. Cash, which ensures that there is healthy cash inflow. The second one is profit generation, which is ensuring there is profit that's coming from the operations. Third is velocity, which is speeding the processes to enhance the efficiency of the business. Fourth is growth, which is investing the sustainable growth of the opportunities. And fifth is the customer focus, which is keeping customers at the center of every strategy. So there is good corporate governance or the CGV, the CGV values and principles, and also the environmental, social governance or ESG, which are measured using tools like a balanced scorecard to ensure that there is transparency and also responsibility. Different topics included in this scorecard, like I mentioned before, the transparency, accountability, responsibility, independency, and also the fairness. Now, another important issue discussed is actually the principal agent problem, which arises when managers, or what we would call as the agents, act as their own interests rather than those shareholders or the principals, and they have like a conflict of interest, and they're sharing asymmetric information, which is causing like moral hazards and also common challenges in there. A company, the internal management will look at the management of how all of these values are being taken care of. So the different sources are the tangible assets, which includes like lands, machinery, and the intangible assets are, for example, nowadays the motivated, skillful employees and also intellectual property. Both need to be managed effectively for sustainable value creation. I'll be moving on to the second part, which is the assets and liability management, which includes the financial risk management. Now let's start with that. Companies will face different type of risks. One of them being market risk, which refers to the impact of the market price changes on the company. And then the second one could be the exchange risk or the FX, which is currency fluctuations that can significantly affect the international operations. And then thirdly is the interest rate. The interest rate risk, which fluctuates interest rates, can impact borrowing cost, for example. Now there is also the task risk, which is part of the other discussion, the other view of which is also viewed by the external investor. There is uncertainty that there are some tax laws that can create financial unpredictability. Now, the principle here is that the balance between risk and return is there. So the higher the risk, it should be accompanied by higher potential returns. So risk can be actually categorized by different type of risk, like systematic risk, which affect the whole market, and also the unsystematic risk, which are specific to a company and can be like mitigated through some diversification. And then we also did something like portfolio management, which plays a critical role here. By using the efficient frontier, we optimize the portfolios to maximize the return at a given level of risk. The CAPM, or capital asset pricing model, which will help us calculate the expected return based on a portfolio's beta or a risk relative to a market, for example. Next following part is actually the financing and also the dividend policy. So the capital structure, which is part of the financing part, involves decisions where you have to choose the right mix of debt and equity, right? So debt financing offers tax benefits as an interest payment or what we know as tax deductible, unlike equity dividends. What means basically is that the benefit of debt financing is good because the interest tax is deductible, but the payment towards the equity providers is not. So that is interesting. Now, there is following the dividend policies, which is related to the equity payments, also play a role in the investor perception. As I mentioned, this is more like the external view. For instance, tax benefits for majority of shareholders make dividends attractive, while the signaling theory is also suggesting like a consistent dividend payments are a sign of good financial stability. And dividends can help build trust and confidence in the market. As the signaling theory basically is action speaks louder than words, which is greater than ever. And the next part is actually the investment strategy, which is part also the external view of the investor. So, investment strategies are vital for the financial success. Of course, there is a key principle here, which is the time value of money, which includes the rule of 72, which is a very simple way of estimating how long will it take for an investment to double. For example, divide 72 by the annual return rate and it will return 6%. It will take 12 years of investment to double that investment, and analysis is divided into different methods like the fundamental analysis of a company's financial health using tools like income statements and also cash flow analysis. And then there's also the technical analysis, which examines the stock price and also the patterns. And then thirdly, the financial statement analysis, which reviews the past performances of the company to preview the future outcomes. So some practical studies that we did in this class, some practical analysis from the experts, and we were able to then move into doing another activity, which was reading a book. For example, I read the book What the CEO Wants You to Know, and using some simulations to practice a portfolio building, an investment portfolio. These are the techniques that help create a more robust investment strategy and also helping our learning throughout this class. Now, last part, and the view of the company and how it aligns with the company's objectives. So ethics and business conduct form the backbone of the company culture, of course. Ethical behavior drives trust, while unethical practices often are motivated by greed, lead to long-term failures, and also real-world examples include stories from movies, like, for example, the Other People's Money, which is something that we watch in order to understand how greed is so bad towards some people. And also, this also demonstrates how unethical decisions can destroy one's business. Now, fraud risk management is another crucial area, as well as red flags for fraud include lifestyles that don't match income, occupational fraud, and also lack of internal controls. Now, moving on to the prevention strategies, which include implementing like a whistleblower policies and strengthening the internal oversight. There is this one case called the R&J Nabisco, which illustrates the consequences of poor governance and also fraud. By managing all of these risks, a business can protect their reputation, also their resources. Now, in conclusion, corporate financial management is about balancing the risk, managing the investments effectively, and also conducting business ethically. By aligning all of these elements, companies can actually achieve a sustainable value creation. And more importantly is to remember that it's not just about making the profit, but it's also about creating a system that works for all the stakeholders while also mitigating the risk and staying true to their ethical principles. That is it for me. Thank you so much for watching.